Hello everyone and welcome to my YouTube channel. In this video, I'm going to talk about the differences between Roth IRA and Traditional IRA. So these are the two individual retirement accounts that give you a lot of flexibility in terms of your investment options. Unlike 401ks where your investment options are limited to ETFs and mutual funds, in Roth and Traditional IRAs, you can invest in stocks, bonds, mutual funds, and ETFs as well. So now let's talk about the differences between these two options. The first difference is tax benefits. For Roth IRA, you make contribution with your after-tax dollars. Once you get your paycheck, you simply take the money out and contribute towards your Roth IRA. Now, since you're paying all these taxes up front, when you take the distribution at the time of your retirement, you do not have to pay any taxes. This includes all the gains that you have made on your investment. Everything is tax exempt. Traditional IRA, on the other hand, is different. In this case, you're making contribution with your pre-tax dollars. It might be the case that you make the contribution after you get your paycheck, but when you file your taxes at the end of the year, all the money that you have contributed towards your traditional IRA is a tax deduction. The difference here is, since you're not paying any taxes up front, when you retire and take the distribution, you will have to pay tax, not only on the investment money that you are putting in, but also all the gains that you have made on your investments. Now let's talk about the contribution limits for both of these options. The annual maximum contribution for both Roth and Traditional IRA is $6,000. If you are more than 50 years old, then you can contribute up to $7,000. An important thing to note here is you cannot have $6,000 contributed to each one of these options. You have to have a maximum. You can have either one or you can divide the contribution between the two as long as your yearly maximum is less than $6,000. Additionally, you have to have enough taxable income. You cannot have $3,000 in taxable income and contribute $6,000 towards Traditional IRA. The next difference is income limits. For Roth IRA, if you are a married couple filing a joint return, you can make full contribution of $6,000 as long as your income is less than $198,000. If your income is anywhere between $198,000 to $208,000, then you can make limited contributions. For single and head of household filers, those limits are lower. At $125,000 and less, you can make full $6,000 contribution. If your income is between $125,000 to $140,000, then you can make a reduced contribution. And if you make more than $140,000 a year, then you cannot open up a Roth IRA account. For Traditional IRA, on the other hand, there is no income limit. You can make millions of dollars and still contribute towards a Traditional IRA. However, your ability to take the tax deduction depends on two things: your modified adjusted gross income and whether or not you are covered by an employer-sponsored retirement plan. Now, let's talk about your ability to take the tax deduction based on these two important factors. If you are not covered by employer-sponsored retirement plan and your spouse is also not covered by such plans, then you can contribute $6,000 and take that as a deduction regardless of your income. On the other hand, if you are not covered by employer-sponsored retirement plan, but your spouse is, then the income limits are similar to Roth IRA. You can make the contribution of $6,000 up until $198,000 modified adjusted gross income, and the contribution starts going down from $198,000 to $208,000. Beyond $208,000, you cannot make any contributions even towards your Traditional IRA. Now, the second scenario is where you are covered by employer-sponsored retirement plans. If that is the case, as a married couple filing a joint return, your income can be up to $105,000 for you to take that full $6,000 tax deductions that you contributed towards your Traditional IRA. If it's anywhere between $105,000 to $125,000, then of course you will get the reduced benefit. And if it's more than $125,000, then you won't get any tax benefit for contributing towards your Traditional IRA. For single and head of household income filers, that limit is between $66,000 to $76,000. So beyond $76,000, you won't be able to get any tax benefits. The next difference is required minimum distribution. So what are required minimum distribution? That's the amount of money that you have to withdraw from your IRA once you reach a certain age. For Roth IRA, there is no such limit. You can keep on delaying it, and even if you die, your beneficiaries will be able to take the money out. For Traditional IRA, there is an age limit, and it was recently increased to 72. Once you hit that number, you are required to withdraw X amount of money, and the amount of money that you have to withdraw depends on the total balance you have in your Traditional IRA and also the life expectancy. Based on that, you'll be taking yearly withdrawals. The next difference is in terms of early withdrawals. If for some reason you have to take money out of your retirement accounts, then these are the options for both Traditional and Roth IRA. For Roth IRA, you can take money out at any age without paying any tax or penalty as long as you're only withdrawing the contributions. You cannot take out the earnings. If you do take out the earnings, then you have to pay 10% penalty and you also have to pay taxes on them. Now, the penalty can be avoided if you are taking out money for certain reasons. So for example, if you're buying your first home, then there's no penalty, you just pay the taxes. Remember, these taxes are only on your earnings. And if you're also taking money out, for example, for qualified educational expenses, then there is no penalty. Now, there is a rule that allows you to even not pay taxes and penalty on the contribution plus the earnings that you have made. And the rule is if you keep your IRA account open for 5 years and after that you take out the money, contributions plus the earnings, for these qualified reasons, which are, let's say, buying your first house, college expenses, and a couple of other things, then you do not have to pay any taxes or any penalty. For traditional IRA, however, there is a 10% early withdrawal penalty, and all the withdrawals that you are taking, they'll be taxed as regular income. There are a few exceptions to avoid paying 10% penalty, but we'll not talk about those in this video. All right, so those are the differences between a Roth IRA and traditional IRA. Now let's take an example and see what will happen if you pick one option or the other. For Roth IRA, if you take $6,000 every year, which is the yearly maximum, and invest it from age 25 to 65, assuming you have 7% return rate, then you will end up with $1.2 million. Since you have paid all the taxes up front, you do not have to pay anything at that stage, and that is your retirement. If you take the same example over to traditional IRA and invest same amount of money, $6,000 every year from same age, 25 to 65, and assuming same return rate, which is 7%, you will end up with $1.2 million. But the problem here is you did not pay taxes up front, so now on that $1.2 million, you will have to pay taxes. When you take the withdrawals, if you are in the 25% tax bracket, you will be left with about $900,000 instead of $1.2 million. That's a difference of close to $300,000. Of course, an argument can be made that the money that you are saving in traditional IRA because of the tax benefits can be invested separately into the market and you can make up for $300,000. That is true, but that's a topic for another video. That's all from today. If you liked the video, smash the like button and let me know in the comments below which option you prefer. Thank you.